Interest rates. People want to know how you know where they're going, what are they doing, and due to misconception, people think that the Fed is the one that actually chooses where the interest rates goes, and it's not. It's actually the bond traders that choose where they go, and then the Fed just reacts to what they're telling them to react to. Very, very common misconception in the fact that everyone thinks the Fed has the power. They don't. Okay, so what happens is they react to what's going on here. And when this goes, they then realize that they have to then cut and react to that. So let me show you a little bit of brown. This is the US 10-year yields and how this has an inverse relationship with bonds, and it also tracks our interest rates. So for your home loans, etc., stuff like that. So how they run is they historically, over hundreds of years, have run on a 40-year cycle. So let me show you that first of all. So vertical line here, you can see we were coming down and we bottomed here in 1941. You can then see we had an increasing interest rate environment up until this period, 1981, 40 years of increasing interest rate environment. Then you can see we've been coming down until 2021. 40 years coming down. 40 years up, 40 years down, 40 years up. So don't freak out and think, oh my word, we're coming back to here. No, it doesn't work like that. It just means that we are now going to be in an increasing interest rate environment, not a decreasing one. Okay, this is where they've high inflationary environment. Okay, very high inflation environment. So then they end up cutting their rates, and they then have a decrease in interest rate environment. Okay, it's all about having money out there to spend to grow the economy, and then pulling money back when they've kind of given too much. Okay, that's just how all the cycles kind of work. So knowing that we've gone 40, this is why I started to look at my interest rates. So knowing that they run in this 40-year cycle, what I then did was then you dive down into this area and start to see, okay, what is it showing me down around this area? So I've used the little replay button and brought it back to the date when I realized that interest rates were increasing. Okay, it was back here at the beginning of 2021, and this is when I was able to lock in my interest rates. So I just want to show you what I was seeing and why I knew to lock in my interest rates at 1.94%. Okay, so as you can see here, we've had double bottom reversal here. And after that, you can also see we've had bullish divergence. So we've had a new low in price, but a higher low. That's showing the momentum of that move has been weakening. So then from there, you'll see that we actually started to then head up. Okay, we changed our market structure. If you also look at when we changed the market structure here and we started to go up, so this date here, 4th of January 2021, see we've then broken our decline. Okay, downtrend's over, come out, got our reversal pattern, and we're back in. During that period there, that's when smart money, and you probably heard the old saying that the bond traders are the smartest people in the room. The reason why is I guarantee none of you have bought or sold bonds before. Okay, mum and dad investors don't buy bonds, professionals do. Okay, so that's the reason why they're often referred to as the smartest people in the room, because anyone trading them are professionals, institutional money or professional traders. Whereas mum and dad investors, crypto, NASDAQ, equities, like they just try and get rich on whatever they can. So if there's ever divergence between what the bond rates are saying and what equities or crypto that are saying, then you can bet your bottom dollar that the stock traders are the ones that are correct. Anyway, once we changed our structure here, that was when smart money then knew interest rates were going. So right now, and again, you've got to think like a billionaire. If you own billions of dollars worth of assets, and we have been for the last 40 years been in a low interest rate environment, money was cheap, you had it working for you, there was no point having it in a bank because you were getting paid nothing. Okay, so they had their money out there working for them, and they had it in high growth stuff to try and increase the capital. So if you're a billionaire and you've got your stuff out there working for you, and you think that there's a chance that interest rates might start to rise, what's the first thing you're going to start to sell in your portfolio? Are you going to sell your Apple and your Microsoft, or are you going to sell the bottom feeder crap down the bottom that has low liquidity that's going to be hard to exit if we ever do get a downturn? So look at that date there when we started to change interest rates there. Now I'm going to bring you over to the Russell 2000, which is all of the low cap stuff. And if you look, we powered into a bull market until that February 2021. So once smart money knew interest rates were going, what did they start to do? They started to distribute out of their small caps. The reason why they have to distribute is because they own so much of it. They can't just sell it in one hit. So they have to secretly distribute it away, sell little nibbles away without alerting the market, as they know that those rates were going to increase. Okay, so that's why then Russell 2000 went into distribution mode for a year, because the interest rates started to build up. Okay, because again, those small cap companies, if you think about how they work, they don't make profit. They're zombie companies. So when money is cheap, yeah, they can go about and they're paying nothing, peanuts on their loans. When those interest rates start to increase, those loans they've got start becoming much larger. So then the unprofitability target becomes much larger, which is why these zombie companies start falling off a cliff. That's why the Russell 2000 starts getting distributed. Then you can notice here, this was the period when here we broke up here in January 2022. This was our official change of structure. Higher high, higher low, and a change of structure here. This was when we entered into our bear market in 2022. Because the interest rates broke up and then everyone got really scared. But as you can see, smart money had already distributed out during that period there because they knew it was coming. Then we've been in an uptrend, and how this works here is that you can see everything works in phases. So the market works in 3 phases. You have what's called an accumulation phase, which is where people aren't aware of it, no one knows, but big money is. You then have a 1/3, 2/3 retracement, which is wave 2. You then get your public participation phase, which is where the public start realizing. The real savvy ones start realizing straight away the minute it takes out the high, but majority don't start getting involved till towards the top. Then you get a 1/3, 2/3 pullback. Then you get the excess phase, which is where everyone's talking about it. It's the talk of the town. Then what happens is you get an ABC retracement, a 1/3, 2/3 retracement of the whole thing. Let's unpack that same story here now in the yield curve. Okay, so here, the accumulation phase here. No one knew about it. Only the real savvy people that were clued on, that were looking at it, knew about that accumulation phase. Then we had our 1/3, 2/3 pullback. So we'll get our fib retracement. And you can see we came down to the fib 382. All right, so now we've had our 1/3, 2/3 pullback. Then we moved into our public participation phase. Those that were really savvy, that were onto it, saw it happening, then got the top of the bear market. People like myself that were shouting, dude, we're about to correct here, major breakout, da 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 da. Okay, so we've had that thing. Then what happens is you go into your public participation phase. Okay, this whole wave here is the public participation phase. I'll unpack these little waves throughout as well in a sec, but just for now, take my word for it. That's all it, and I'll explain why in a moment. So then from there to there, you can see we've now had our 1/3, 2/3 retracement again. Okay, then we've gone up to our peak here, and often what you'll get is you'll get divergence from the top of the public and the top of the excess, which is what you've got here. Because that's when, remember I was talking about the excess phase, every man and their dog are talking about it then. I started to see ads. Everyone was aware of interest rates there and talking about how bad it's affected them. I started seeing ads on TV about, make sure you do this before your interest rates keep going up. It's just, it goes over and over and over again. So knowing that, what we're going to get is a 1/3, 2/3 retracement of the whole thing. So right, so we have accumulation, public, excess. We then get a 1/3, 2/3 retracement. And you can see that would be a nice healthy move down to here. Okay, so right now, what we have is wave 1, wave 2, wave 3, wave 4, and wave 5. So we're going to now get an ABC. A, B, C. Okay. That 382, similar to here, if you look at what it also aligns with, it aligns with a major resistance that's now going to become a major support. Okay. Why is that an important level there? Because if I zoom out and show you the bigger time frame, you can see that that is the point where we changed market structure for the first time. So you can see here, we peaked, selling lower, selling lower, selling lower, selling lower, 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 equal. And now they're selling higher for the first time. So since 1980, they've been selling higher every other time. You can also notice that they've been buying lower, 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 equal, lower. So what we're looking for now is for them to be buying higher. If they do buy off here and go up, then that is your confirmed reversal that we have moved from a decrease in interest rate environment into an increase in interest rate environment, which means that those lows you'll never see in your lifetime again, because we know it runs off a 40-year cycle. It also means that if you miss locking in interest rates here, this would be your next best spot to lock it in before we get ABC, and then we move up and continue the trend again. Okay. I've got a target of around this kind of 7% range here as the first zone that we get to, which also happens if you look at by the time we come down and come back up, look at the date, 2026. Also happens to align with the real estate cycle, 2018 year real estate cycle, 2026 is around that. So right now, people are super excited because they're cutting rates. Oh, good, they're cutting rates, everything's going to be okay. Sad thing is they don't cut rates out of the goodness of their heart. They do it because they've broken something so bad that they don't have a choice. So when the fact that they're cutting rates, that this is coming down, means that, again, it's not out of the goodness of their hearts because they've broken something so bad. And that is actually historically when the biggest crashes happen in equities. So let me show you that. Okay, so when the Fed pivots, which is this, starting to pivot, stocks crash by more. So you can see historically, GFC 50%, .com 40%, recession. So they all crash after the Fed pivot. Here's it on the chart. So once it pivots, that's when we crash. Okay, because like I said, they're not pivoting out of the goodness of their heart. They're pivoting because they have no choice. Their hands are tied, and if we don't pivot, we're going to collapse. So they have no choice. They try and keep the bubble afloat as far as they can, but eventually their hands are tied. They don't have a choice. Now what I'm going to show you is the yield curve, because that's where you then know when things are going to get nasty. So the yield curve is just looking at this US 10-year over your US 2-year. Hit enter. This is what's called the yield curve, and it's a leading indicator for a possible recession. And you can see here, last time we were here was 2019, and then here was the COVID crash, which was your flash crash recession. The only reason we didn't fall into recession is because they printed their way out of it. They didn't have a choice. It was either that or everyone's going to have riots, being locked up in their houses, etc. Then back here, 07 GFC. Okay, here, tech bubble crash. Back here, the 94, and back here, 89. Okay, and what you can look for here is these have led to the reset. It goes back. We haven't been this inverted since the 1970s, which is when we had extremely high inflation and an energy crisis last time. If you look at when the crashes actually happened, so let's zoom in and look at when the crashes actually happened on the stock market. And it's actually when we changed market structure. So once we change market structure that date there, 24th of February 2020, is when we started the crash. Let me show you. Let's go here, split the screen. And over here, I'll show you the NASDAQ. And let's find that exact date there, 24th of February. We'll go to the weekly as well, so on the same time frame. And back here. So date there, 18th of February. So that's the 24th of February. What happened? Crash, crash, crash. So when the yield curve uninverted, the NASDAQ crashed. Maybe it's a coincidence. Let's dive again. Look at the next one. Okay, let's look here. This is during the GFC. So once we confirmed a reversal, double bottom, broke above, date there, July 07. Let's go back and look at that date. So let me get rid of the scrolly lines. July 07. So March, September. Oh, sorry, that's tech bubble. Wrong one. Let's go here. July 07. So we are here. So July 07 here. They had one last push and then crash. Okay, so or say August 07. So August 07 here, they had one last excess phase push and then a crash. Okay, massive crash. Once we uninverted. Now let's look at the tech bubble. So same thing here. We were coming down. Once we uninverted. Okay, so here, date there, December 2000. Let's go December 2000. And we are, so December 2000, was it? So that's actually down here. So December 2000 is here. All right, so right here, December 2000, where is it here? We then started to crash. Okay, this one was actually already in a bit of a downturn. But again, major crash. All right, let's go to the next one. $1994. So this little one here pivoted. It was just a little tiny crash there. Let's look at a bigger one here. 1990. So here, when the yield curve uninverted, July 1990 was January, July, June, July. There, 1990 crash. Okay, when yield curve uninverted, crash. Okay, so coincidence? I think not. It's happened on every single time. So what does that mean for us now? Let's have a look. So where are we right now? So we have come down, we're uninverted, and what you've got here is a falling wedge. Okay, falling wedge on bullish divergence. That in itself is a reversal pattern. That then turned into a double bottom. Okay, double bottom on bullish divergence. That's now been tested as support, and now we're floating. So the minute that we then start to get above here, we will then start to get out in our, we're starting to uninvert just like we have all those other times, which would lead to, as history suggests, again, this is me not telling us that this is just me going off history. I always go back on past data and see where we're at, would lead to that. On top of that, let's actually unpack where the NASDAQ even is. So if you look at the NASDAQ, where is the NASDAQ? So since the last crash, you can see that this is your accumulation phase. Higher high, higher low, we broke out. We moved into our public participation phase. And then we have our excess phase. So you know where we are, which means that we're then going to get a 1/3, 2/3 correction of that whole move. Okay, this here was a 1/3, 2/3 correction. This here was a 1/3, 2/3 correction. Okay, 382. So accumulation, public, we're in the excess phase. How long this excess phase goes for, we don't know yet. But this is where you got to think to yourself, do I need to get every little ounce of blood out of the stone? No. Why, when a balloon's already so puffed up and it could pop on any next puff, why risk it? Why risk it when there's this thing here doing this and you've got something like silver, which is down the other way, where it hasn't done anything for 40 years. and is down around here and is actually just changing market structure. It's just coming out of the accumulation zone. So you've got to think about, for long-term wealth, is it worth the risk? Okay, yes, it could go up a little bit further. Could go up for even a year or two more. Doubtful, but it could. But it could not. It could pop tomorrow and then you're caught holding the bag. So you've got to think to yourself, risk to reward. The risk to reward on something like silver is phenomenal. The risk to reward on something like the NASDAQ is absolutely terrible. And if you want to know how they have like an inverse relationship, let's have a look. So back here on NASDAQ, okay, so when silver topped here in 2011, what was breaking out of the accumulation zone? NASDAQ. So when something was historically expensive, something else was historically cheap. The NASDAQ was. Okay, same thing here. Here, last time silver was historically expensive in 1980, the NASDAQ was historically cheap. Let's use the S&P because the NASDAQ doesn't go back that far. All right, so here, 1980, last time silver was historically expensive, what was historically cheap? Equities. Boom, massive bull market and thing. Then when equities are in a bear market, going sideways doing nothing, what does silver do? Here, bottom of, so when that's expensive, silver's cheap and it goes into a bull market. So silver goes into a bull market and this is correcting. And when this is in a bull market, silver's correcting. So put two and two together, guys. Like the market tells you a story. If you know where to look, it's so obvious. This has just changed market structure for the first time since. So equities are expensive, precious metals are cheap. I hope that's getting through to you. And again, if you're a crypto enthusiast, we know crypto follows NASDAQ. It's blockchain technology. So you've also got to think about that as well. Anyway, hope that helps, guys. Helps you know what to do with the interest rates. Me personally, like I've got massive arbitrage on my loan right now. Like I've got mine locked in at 1.9%. I've got the money there to pay it off, but I'm getting 4.5% in my term deposit against a 1.9. So I've got 2% arbitrage. I'd be silly to pay it off. So you try and think about that. If we do rate cut, when it does bottom, lock it in. And when they go up, you'll then have arbitrage as well. And the fact that any money you've got can be locked up at that rate. And then it'd be working more for you going the other way. But anyway, hope that helps, guys. If you like the video, please like and subscribe and let me know what you'd like to see on the next one.